Good morning, welcome, and thank you everyone for attending today. My name is Joe Oltmanns. I'm Senior Vice President at OTC Markets. I've been at OTC for 14 years now. And my role really at OTC is to help companies make smart decisions around listing, whether it's moving within our framework of the pink market upwards to OTCQX or OTCQB, whether it's companies moving from OTC onto an exchange, or more recently, companies moving from an exchange onto OTC markets. But why I'm here is because there is a big problem in microcap. There's a big problem. The S&P is hitting records high, the Dow, the Nasdaq, but microcap is not. And here's the hidden truth of microcap. Over 600 companies on both the New York and Nasdaq have received non-compliance notices. Of that number, 450 of those companies are listed on Nasdaq, meaning 1 out of 6 companies on Nasdaq right now are non-compliant. It's a very big number. And of that Nasdaq number, 80% of the companies are non-compliant due to falling below the minimum price requirement of $1 per share. We offer a much tailored marketplace for microcap companies. As these companies are in this situation on both Nasdaq and New York, they have a big decision to make. Many of which is a reverse split to maintain your listing, or it's to kind of move onto OTC markets. We operate a market of 12,000 securities across the board. It's very, very large. We divide our market into 3 different categories or tiers for listing. The top one is OTCQX, the middle one is OTCQB, and the bottom one is pink. For anyone here that still uses the terms or references, pink sheets or bulletin board, you can look at our market and say the pink market kind of replaced the old pink sheets. The QB market replaced the old bulletin board, if we still use that term. And QX is our top brand, top market. Most of the companies that move from the exchanges to our market will look to qualify and apply for OTCQX or OTCQB. They both, like an exchange, have financial standards. They both have corporate governance standards. Examples of companies that have moved to our market on QB can be Fannie Mae and Freddie Mac. When they came off the exchange years ago, they went to OTCQB. A name you may know on OTCQX, which actually now has moved onto ARCA, is the Bitcoin Trust, GBTC. There is plenty of liquidity on our top 2 markets for OTC markets, QX and OTCQB. Similarly, because of the regulatory recognition we have for both the 2 top markets, you also have blue sky exemptions for both OTCQX and OTCQB. And for companies coming off an exchange where they have the full exemption, it makes it very easy for companies to kind of move off and transition from Nasdaq or New York onto OTC markets. Our bottom tier is pink. It's our default market. So to answer a question, if companies do nothing with OTC and coming off an exchange, where do they go? The answer is pink. WeWork went to pink. Bed Bath & Beyond went to pink. Silicon Valley Bank went to pink. Any company in bankruptcy is not going to qualify for our higher 2 levels, the default market again being pink. So another big question is, why make the move? Why switch from Nasdaq or NYSE to OTC markets? First and foremost, I know shorts is a big conversation around here, short selling. And I know one would say one of the arguments against OTCs, those securities are not margin eligible, and that is correct. But think about looking at shorts, because the company is margin eligible, is more likely to be shorted. So keep that in mind. If you're looking to reduce short positions, OTCQX is better than Nasdaq and better than NYSE. Regulatory recognition. Many times I'll be asked the question, how are you guys regulated? We are regulated by both the SEC and by FINRA. Our top 2 markets are called established public markets per the SEC. So for any attorney working on an S1, for example, to file a resell S1, you can sell at market prices on QB and QX just like an exchange. You cannot, though, do so for pink. Pink is a fixed price marketplace. Can you raise money on the OTC market is another big question that we get. And the answer is yes. We have not been an IPO market, for many, many years. Maybe that's why people think companies can't raise money on the OTC market. But our OTCQB market is roughly 6,000 companies. Those companies are pre-revenue. They are raising money all the time. So companies, yes, can raise money on our market through a private placement, a Reg D, Regulation A, or through an S3. It's the same process as NASDAQ. Blue sky exemptions I mentioned earlier before. We have 38 states for OTCQX. We have 36 states for OTCQB. It gives brokers the ability to recommend OTC securities once they move off an exchange. Again, there isn't much difference on the regulatory side as companies come off an exchange onto our market. A common question I get too is liquidity. You know, how liquid is the OTC market? It's a common, I guess, argument that I always feel the need to make. But a lot of times, your market makers on Nasdaq and NYSE just transfer over to OTC once you make the move. Citadel, Jane Street, StoneX are all large market makers of ours. A lot of times, they just go from one place to the other as companies move off the exchange. Pricing-wise, we're very competitive. We offer a very fair price for microcap companies to list and join our markets. Our fees are less than half of Nasdaq's and NYSE's. We don't charge or nickel and dime, so we don't charge for additional listing of fees. We don't charge for hearings. We don't charge for a bell ringing ceremony. We don't charge for corporate actions. Our fee for OTCQB is $15,000 per year, and that's a flat fee. The fee for OTCQX, the top market, is $25,000 per year. That's a flat fee. Those fees are well less than the exchanges. And for microcaps that are really, cash conscious, especially right now, it makes a lot of sense to look at your other options versus paying a six-figure bill each year just to be on Nasdaq or NYSE. Hearings, I know the fees were increased last year on Nasdaq from $10,000 to $20,000. So again, think about all the fees that kind of add up. If you're non-compliant, you have a hearing that's $20,000. Then there's a reverse split, maybe another, say, $10,000. Then you have your annual fee, another $50,000, $60,000, $70,000. And there's no guarantee, even through all of that and all those fees paid, you'll still maintain your listing on Nasdaq or NYSE. Liability insurance, we don't require as big of a board as the exchanges do, especially for smaller companies. They don't need a big board. So with that, there are less costs on D&O insurance. Our market is based off disclosure standards. For OTCQX and OTCQB, our listing standards are lower than the exchanges. No doubt, they are. But where we compensate for that is on disclosure. We provide investors more transparency in data than the exchanges do for microcaps. The one thing I mentioned earlier was our tiered system, right? We help investors identify which companies are pink, which ones are QB, and which ones are QX. Many pink companies maybe have applied to QB and were not approved, and that's why they're on pink. So we do more for the investors on a vetting process to kind of let companies know which companies have gone through our review process. Transfer Agent Verified Shares Program, I saw B-Stock here earlier. They're a member of our Transfer Agent Verified Shares Program. We love data, and we love good data and real-time data. Stock promotion flags, we identify to the market what companies are undergoing a promotion. If it's active, we'll keep a flag on our website. Shelvers flags, we look at balance sheets of small companies. We'll look to see at the asset sizes. We'll identify which companies we believe, according to our modules, that could be potential shell, and investors, should know that. Convertible debt, it's a big thing for microcaps. There's a lot of dilution with microcaps, and investors should kind of know what's going to happen next. They should know how much debt is outstanding and what the consequences are of that debt once it does convert into equity. What your investors see when companies join OTC markets, again, it's more than what they see on Nasdaq's or NYSE's website. We'll show the outstanding shares. We'll show how many shares are restricted, and that's real-time data. So if you're trying to trade or invest in a microcap security and you try to figure out the float or the volatility or what's available in the float, this data gives you that ability to look that up. We also show level 2 quotes. For those that don't know what level 2 quotes is, it shows depth of book. It shows the market. It shows who the market makers are. It shows where their price points are, the dates of when they put their prices into the system. You won't find this transparency on Nasdaq's website. You will find it maybe on your Schwab account if you have level 2 activity, but again, we show it for investors on our public website for free. The Verified Shares Program I mentioned before, again, we verify shares outstanding. We verify the float. We verify how many shares are restricted. That way investors can make better decisions on investing in microcap securities. So what happens when companies, decide, if they do decide to leave Nasdaq or NYSE and join OTC markets? We make an announcement. It doesn't go unknown. We offer virtual market opens, or we offer in-person market opens. It's not going to be on, Times Square, with Nasdaq. It's not going to be, outside NYSE, But for that, we charge $15,000 per year for QB and $25,000 for OTCQX. We make things much more simple for companies. But we do get the message out there. In addition to having an opening bell or a virtual market open, we issue a press release. We'll inform all your market makers, right, that the company is coming over to OTC markets so that they're aware. So Citadel, Jane Street, StoneX, they all know what's going on as companies move off an exchange onto our market. Visibility-wise, we try to do a little bit, not take the place of an IR firm. So we have a video series, a CEO video series, just to kind of get the story out. It really is hard to find information on very large companies that are out there. And as you go down the ranks to microcap, it becomes almost impossible. So we try to do our best to kind of give companies the ability to tell their story as they start out on OTC markets. And so what's involved? The company did want to move forward, moving off from Nasdaq onto OTC or New York onto OTC. There are two ways to do it. There's a voluntary switch where you get to control the narrative a bit more and tell your investors, why you're doing it. That's option A. Option B would be to just switch, after you've kind of been removed off the exchange. But going back to our top two markets, OTCQX and OTCQB, they require applications. There are listing standards you have to meet. And so like an exchange, we have an application. The review is not overnight. So if you're coming off of an exchange onto OTC within 1 week, we can't get you onto OTCQB in 1 week. We just can't. We have a process to go through. We usually ask for about a month in advance when companies look to move to our market to give us an application so we can review it and get you onto OTCQB kind of out of the gate. Companies, yes, can move from Nasdaq or New York onto Pink and then work their way up to QB and QX. That's fine. But I think for most companies, as they make the move, it's always best to join the market that you want to list on out of the gate and not really move on to Pink. There are a few exemptions for companies coming off an exchange onto our market with our process. That's why it does move a little quicker. So it's a good advantage for companies on Nasdaq or NYSE. Ongoing compliance. Your SEC rules are your SEC rules. Companies may think if you go to OTC markets, there's less disclosure required. The answer is no. Your SEC work is your SEC work. Nasdaq New York may have some separate rules you have to abide by as a public company. Those rules, yes, go away when you join OTC markets. But all your SEC reporting and your audits and things like that still have to be done. Again, your board, for OTC, QB, and QX, we have board requirements, corporate governance requirements, similar to the exchanges, not as robust or expensive, but we do. In summary, I would say, moving to OTC is not a death sentence. There's plenty of liquidity, on our market. There are 12,000 names on our market. On our top tier, we trade a lot of global ADRs like Heineken, Roche, and Adidas. We have a lot of good names. Liquidity-wise, we're very liquid. And looking at the cost of our market, it's much less than the exchanges. Going back to the Nasdaq, problem I mentioned earlier, those companies have a lot of thinking to do as they approach the reverse split. But for the most part, reverse splits don't work. They rarely work on the back end of good news, let alone bad news. And we've seen companies over and over again affect reverse splits just to kind of maintain their Nasdaq listing. And then a year from then, they're right back in a non-compliant situation, and they're calling OTC markets to join. And by that time, the liquidity has been cut almost threefold, and they don't trade. And they're probably 30% less in value than they were a year ago. So companies really need to be smart about the reality of the current market. And make good decisions. So thank you for your time today. I do appreciate it. I'd like to open up for any questions if there are any at this time. There's a question over there.
Thank you. Are there any markets, any brokers that don't allow trading in OTC markets? Why don't they? And how are you addressing that?
So brokers have their own rules, to be clear. I think on the pink market, you'll see far more restrictions, yes, on trading pink securities versus OTCQX and OTCQB. Keep in mind that some brokers also have, price requirements to trade securities, and that applies to Nasdaq, New York, and OTC, whether it's $5 per share or $1 per share. But the rule of thumb, I guess, for OTC-wise, if there is an issue, the best choice for a company is if they qualify to apply for OTCQX or OTCQB.
Thanks for the presentation. Question, do you allow ATM transactions at the market?
We do not, no.
Okay, thank you.
I have a client that's trading at 2 cents on the pinks. They have a certified audit in the works to uplist to the QB. Do you recommend, first thing is, do you recommend that they, do you recommend that they do a reverse split?
So I'll go back to
Seems like a long way to go from 2 cents to decent price.
Well, so going back to the listing standards, I didn't get too into the weeds on things, but for OTCQB, the middle market, the only financial metric to qualifying for QB is a penny per share. So the company, your client, would obviously already meet the price requirement if looking to join OTCQB. Nasdaq, you're right, is $4 per share. It's a much bigger reverse split to get there.
Right now, they've being at 2 cents, they want to go up. I've been told that no one is going to be able to sell their shares anyway. Is there a difference between pink shares trying to get into an account and QB shares trying to get into an account?
There are. Going back to our regulatory recognition across the different markets, again, QB and QX are SEC-recognized public markets. The pink market is not. So, and brokers also follow the same kind of rules and policies that we kind of put in place. So, yeah, pink is challenging, there's no doubt. QB and QX are a lot safer.
They also have a Reg A follow-on offering, this pink sheet company. And I've been told that even if they are successful in that Reg A, those shares are worthless. It can't be put in a brokerage anywhere. Is that true?
No. In that situation, if they are working with a broker, for example, on the Reg A transaction, the broker or the transfer agent is part of that. You kind of help out in that regard in terms of getting shares deposited. But no, there are over 1,000 companies on our OTCQB market. Our market is not new. It's been around for decades. There are plenty of companies that are sub 5 cents, even sub a penny, that trade very well per day.
Could you give us a sense, what's the average market cap in the QB market and in the QX market?
Good question. Obviously, that number is changing right now. But I would say average for OTCQB, roughly between 7 to 10 million, I'd say. This is domestically, I'm speaking, I'm excluding the global companies on our OTCQX market. But domestically for OTCQX, roughly, I'd say 20 million, 25 million. But keep in mind, a lot of the companies, that I'm looking at on the exchanges on Nasdaq that are below $1, almost all of them are pretty much, sub 50 million, if not even sub, 30, 25 million. So we're in a really good position, to provide value to these companies as they come off the exchanges or as they receive a non-compliance notice. One thing to mention earlier about the requirements for OTCQX, the top one, we do not allow for penny stocks on OTCQX. We purposely, put that in our rules. Why? Is because there are many funds, for example, that quote unquote in their bylaws do not invest in penny stocks. Our solution or our problem to fix that was to create a special carve out of QX where we do not permit for penny stocks.
Yes, sir. Thank you for presenting. How long have you had this position?
I've been in OTC markets 14 years now. I've been, I guess, working with the U.S. market in listings of those 14 years for the past, I'd say, 10 years.
My question leads into, you've seen a lot of things happen. I'm a little disgusted with, like I explained to you before, I'm going to talk to you about Lumina and CenturyLink. I had a similar company called Frontier Communications that screwed me. They screw the shareholders, then they go right back in the business again after they wipe us out. I'd like to ask you, how many times do you give these companies a chance? Or is there a certain point where you block them from screwing shareholders?
So the OTCQB, the top two markets, again, have initial listing criteria and ongoing listing criteria. We have a compliance team that monitors the companies on QX and OTCQB. They will not remain on those two markets if they fall out of compliance. Just so you're aware, our compliance thresholds in terms of timelines, we don't give companies a year like the exchanges do to regain compliance. We give them about maybe 30 days. So to answer your question, for the higher two levels, we have a pretty robust compliance process in place. If a company is doing wrong or not doing their part, they are removed off QB within a month. We don't give long extensions. In the pink market, however, it's risky. We don't really have much formal engagement with the pink companies that trade on our market. So as an investor looking in trading OTC securities, know that. We don't vet pink companies. We have no engagement with the pink companies in many cases. We don't review their disclosure. So it is definitely, yes, a more risky market than the higher two levels. I think I'm out of time, so thank you.